तेरा जुनून.
Great morning, my dear friends. Bhupesh Anand this side. So today we'll be starting with reading number 55, the last reading of this fixed income. So we have covered, 5 readings, and today we'll be on the 6th reading, reading number 55. And this reading is, has been introduced by CFA Institute after 2008 crisis, because people were more relying on the credit reports. People were more relying on the credit rating agencies, and even the highest grades given by that credit rating agencies also fall down. So there was a need, that to put an emphasis that how to do a credit analysis. It means a credit analysis which is being done by a credit rating agency, whether we can, whether we can depend on it or not, or what are the factors to be taken into account, what are the limitations of that credit report. So today we will be starting with that reading number 55, and the name of the reading is Fundamentals of Credit Analysis. We have discussed so many things in relation to fixed income in last five different types of readings, and so many learning outcomes. So today the last conclusion will be that how to analyze a credit, fundamentals of credit analysis. It means a borrower, a lender, a investor, if he wants to lend or invest in a bond, then what are the factors to be taken into account by that hedge fund, by that portfolio manager, along with credit report, that how to analyze the credit, that whether the borrower is okay or not, or whether that lender should give the money or not. So these are the points to be taken into account. So please take out your registers, my dear friends. Great morning. You have to write down, because once you write down, I'm telling you, the whole concepts will be flowing in your mind. Please write down. Please take out your register. The last reading of fixed income, reading 55. I have given 3 stars to this, a highly, testable area, and 10 learning outcomes. In today's lecture number 1, I will be discussing 2 learning outcomes. So very easy reading, logical and conceptual. So learning outcome A to J. The first learning outcome is, what is the meaning of a credit risk? Today we'll be discussing, and what are the credit related risk affecting bonds. And second is describe default probability and loss severity. Credit risk has 2 components. One is default risk and second is loss severity. So we have to do learning outcome A and B both, because they both are gelled together. So we cannot differentiate them. We have to do LOS A and LOS B. Along with that, what are the credit risk related with corporate bonds? So today I will be discussing with A and B, but in the next lectures I will be covering all the learning outcomes. That third learning outcome is highly testable, that how you will give the rankings to your security rankings to a corporate debt. Then what is the difference between corporate issue credit rating and issue credit rating? When I say Apollo Tires, it is if I am giving credit rating to Apollo Tires, it is a corporate credit rating. But Apollo Tires has issued so many different types of bonds, and now they are issuing a new bond, and the credit rating to that particular issue is named as issue credit rating. So there's a difference between umbrella credit rating and a small umbrella within big umbrella rating. So these two have the differences. So we will be watching that, because after 2008 crisis, we have to see that, how to analyze a credit. So learning outcome A, credit risk. Then we have related learning outcome number B, that is default risk, severity risk, and then what are the rankings if a company goes, if a corporate entity become insolvent or bankrupt, then how the payments will be made, how we will be creating a seniority, So that is covered in C concept. And then the difference between the corporate credit rating and issue credit rating. And similarly, the risk involved. Supposedly, if I am relying on Standard and Poor credit rating, CRISIL credit rating, ICRA credit rating, CARE credit rating, that whether I can rely 100% on that. Or what are those factors? What are the limitations of credit rating? Because a credit rating report or credit rating symbol does not give you that how much is the risk of default. They have just given the categorization: AAA, AA, single A, triple B, double B, single B, and all that. You getting my point? So that credit report does not tells me that whether tomorrow earthquake will be coming, or whether there will be an internal problem, or whether MD will be going for a suicide or not. It hardly matters whether GST will be applicable to you or not. It is a particular point of time the credit report has been given, but it changes, it varies. So what are the risks involved in that credit rating? We will be discussing with that. And in traditionally, what 4Cs we were doing? LOSG will be discussing with the financial ratios as we have discussed in financial reporting, how to calculate profitability ratios, debt equity ratios, and solvency ratios, and long-term solvency ratios, and short-term solvency ratios, so that we can, just like a human being, we check, generally doctor check blood pressure, generally doctor checks, the sugar level, diabetes level, ECG, heart level, kidney function level, so that doctor can analyze, the human body properly and can diagnose the problems. Similarly, with the CFA, an analyst can diagnose a problem by financial ratios and the credit quality. So we will be doing with all this. So let's start the journey. And I will be telling you something along with, with Google Baba. Google Baba, I have taken in Investopedia that what is the meaning of credit analysis? What are the risks involved in credit analysis? And what are the credit risks involved in corporate bonds? What is default risk? What is loss severity? So that 2 or 3 points we will be discussing in learning outcome A and B. Just see what they have given. Credit analysis is a type of analysis an investor or bond portfolio manager performs. It means the investor has to perform own companies or other debt issuing entities to measure the entity's ability. I have given the money, so whether that company will able to pay me or not. The credit analysis seeks to identify the appropriate level of default risk associated with investment. That how much is the default risk in Kingfisher Airlines, for example, that banking company, Canada Bank, Punjab National Bank, so many banks, they have given the loan to Kingfisher Airlines. Now they must have done credit analysis before giving the loan, that whether Kingfisher Airlines will be able to return their money or not. Similarly, with case of MTech Auto, we have discussed so many times MTech Auto case study in alternative investments in equity also, that whether those bonds which are being issued by MTech Auto, that the amount can be returned, whether that amount will be returned by MTech Auto or there will be a default. So we have to find out the default risk, and when there is a default, we have to calculate the loss severity, that given default, how much will be the loss. So these are the concepts which we will be discussing with. And credit analysis is used for credit rating, junk bonds and all that. We will be discussing with that. So let's start the journey. Please take out your registers, and you have to write down 3 or 4 small PowerPoint slides I have written for you. So let's start the journey. Credit risk. Now when I say credit risk, as the name indicates, if I am giving you a credit, or I am selling the goods on credit to a customer, that whether that customer will be able to pay me or not. So for that we generally have a factor, there is a factoring agreement. Similarly, in case of bonds, in case of loans, the borrower will be able to pay or not to the investor, to the lender. That risk which is involved between two parties, that whether he will be able to pay back interest or not, principal or not, on timings or not, that is named as credit risk. So please write down, credit risk refers to the possibility that a borrower fails to make the scheduled interest payments or return on principal. So this is credit risk. So I am going to start with, what are the components of credit risk? Credit risk has 2 components. One is default risk, that how much is the probability that this borrower will make the default, how much is the probability that Kingfisher will make the default, how much is the probability that MTech Auto will make the default, how much is the probability that General Motors will make the default in USA, and what is the probability that they will become insolvent, and how much amount they will be paying to their borrowers, So the point is credit risk is due to, or it has two components. One is default risk and second is loss severity. When I say default risk, how much is the possibility or how much is the percentage or how much is the probability of making default by Kingfisher. That is named as default risk. So please write down third point. Please write down, my dear friends. Sit straight. Write down default risk is the probability that a borrower or a bond issuer fails to pay interest or principal when due. It means when interest is due 6 monthly or yearly, and whether that borrower will be able to pay or not on the due dates, whether he will honor his own words or not. That is named as default risk. And loss severity, supposedly he has made a default. Kingfisher has made a default. Now Canada Bank has to find out how much will be the loss severity. It means step number 1 is default. And step number 2 is to calculate the incidence of loss. That is named as loss severity. So loss severity means loss given default. It means first event has already happened. Default has happened. Then how much will be the loss? It refers to the value of a bond investor will lose if the issuer defaults. It means condition number 1 must have happened, that there is a default, and then how much he has lose. Loss severity can be stated as a monetary amount. Now we can calculate it in percentage or in a monetary amount, that how much will be the loss if default is there, and we can have a percentage of default in percentage of default also. So I have taken a case study for that. Expected loss, how much is the loss? Percentage of default into loss severity. When I say loss severity, it means loss given default is there. So that we will be clearing. Don't be shy. I will be telling you each and every point with the help of a case study. No need to read CFA curriculum, those thick CFA curriculum study materials. No need to read squares. You will be weakening your eyes. Don't read it. Just listen to my videos. Go over CFA curriculum like practical problems which I have done. Okay, and directly go for mock test and all that. So expected loss is default risk into loss severity. Expected loss can be stated either in the monetary value in rupees or in percentage. Now what is the recovery rate? When I say loss severity, this is the loss. Then how much will be the recovery? It means loss severity plus recovery is equal to 100%. So I can relate them. Recovery rate is equal to 1 minus loss severity, or loss severity is equal to 1 minus recovery rate. So please write down 6 point. Recovery rate is a percentage of bonds value an investor will receive if the issuer defaults. And the loss severity is the percentage, the loss given default is there. It means if a total bond worth is $1,000, and if I say loss severity is $300, it means $700 will be recoverable amount and $300 will be severity. Now how to calculate that default loss? So for that, I have taken a case study. Please write on this case study, very important. Market value of bond, let it be $1,000. Let it be market value of a bond be $1,000. And let the probability of default, we have calculated with the help of statistics, let the probability of default be 10%. And loss given default. If default is there, now that condition number 1 is default. That is the probability is 10%. Loss given default is 30%. Calculate expected loss. So I have calculated expected loss, probability of default into loss given default, probability of default into loss given default, 10% into $300. That is $30. Now how I have calculated loss given default? This is $300. So how I have calculated this? I am given with 30% as the loss given default. So 30% of 1,000. So I have calculated 30% of 1,000 face value, that comes to $300. So I have used this 300 here for calculating the expected loss. So 10% default into loss given default, that is $300. So let's start with the new point. We have covered or the same Market value the same is here. If the loss given default is 30%, it implies recovery ratio is 30-70%. So please write down this answer also of case study. Please write down. If the loss given default is 30%, then it implies recoverability ratio. Recoverability ratio is 70%. So expected loss is equal to probability of default into loss given default, so 10% into 300. So like this we have calculated. So the next learning outcome which I am going to start with, I am doing learning outcome A and B in a mix, So credit risk is given to me learning outcome A. And the components of credit risk is given to me learning outcome B. So I have covered default risk and loss severity risk. Now again I am in learning outcome A, that what are the risk attached with, what are the credit risk attached with corporate bonds. When I say a corporate bond, it means a bond issued by a corporate entity, by Ranbaxy, by Coca-Cola, by Pepsi, by Honda Motors. They have issued a bond. At that time, they have this type of credit rating, but after some period, they are due to some event, due to some happening, due to some next tax status, the credibility can have a, there is a decline in the credibility. So we will be discussing today that what are the credit risks attached, related with the risk, credit related risk affecting corporate bonds. Now there are two types of credit related risks. Now just see, in case of treasury bond, in case of risk free bond, in case of a treasury bill, a government security, there is a rate of interest, there is a coupon rate, and a bond issued by Apollo Tires, there will be a rate. Now there is a difference in these two. The rate, the interest, the coupon rate offered by Apollo Tires is more than treasury bill. For example, I am just taking 12% as a coupon rate which is being offered by Apollo Tires for issuing their bonds, and 8% as a rate for risk free. Now there is a difference of 4%. 12% minus 8%, 4%. So why Apollo Tires is giving more 4% to their investors? Now the question is, because in case of corporate bonds, those investors are facing multiple types of risks. Now what are those types of risks? One can be credit risk, the credibility risk, the downgradable risk. Earlier they were allotted a AAA as the category of credit quality. Now because of some event happening there, due to internal or external problems, now that AAA rating has been notched down to, NOTCH, notched down to AA or to BBB. Now because of that, the spread will increase. And because of spread will increase, YTM will increase, and because YTM will increase, bond price will decrease. So this type of risk of creditability is named as downgradable risk. So there are two components we will be discussing with that. One is downgradable risk and second is liquidity risk. So I have prepared the analysis, I have prepared the handwritten slides. It will be better if you just write down point number 7. Credit related risks affecting corporate bonds. Bonds with credit risk trade at a higher yield. It's very natural, that in case a bond, a newly started company has a more credit risk as compared to Apollo Tires. So this newly company, because has more risk, so has to give more return, more yield will be there, more coupon rate will be there as compared to AAA. So A point, bonds with credit risk trade at a higher yield as compared to the bonds with free of credit risk. For example, treasury bills, spread. Now what is the difference between spread? I have just given an example. Apollo Tires are issuing bonds at 12% and government securities are being issued at 8%. So difference between these two is named as spread. The difference in the yield between credit risky bond and credit risk free bond is named as yield. The wider the yield spread, the more the spread, YTM will be increasing. And when YTM will be increasing, the bond price will decrease because YTM and bond price have an indirect or an inverse relationship. Getting my point? We have discussed so many lectures in so many lectures. So please write down, a wider yield spread implies a lower bond price and a narrower yield spread implies a higher price. So we are doing the risks related with corporate bonds. What are those credit risks which are related? What can be the possibility that corporate entity who has issued the bonds who is a borrower, will not able to pay that. So we are discussing that there are two types of components in that credit related risk in relation to corporate bonds. One is downgradable risk, spread risk. It is the possibility that the bond loses value because its credit spread widens relative to its benchmark. Spread risk, please write down spread risk. It means the difference between the corporate bond rate and the benchmark rate. If it increases, if it widens, it is named as spread risk. Now, why it widens? Why this company is giving more coupon rate as compared to benchmark? It can be due to different reasons. But the point is, the more the distance, more will be YTM and less will be the bond price. So please write down D point, spread risk. It is a possibility that a bond loses value because its credit spread widens in relation to benchmark. So spread risk includes 2 points. Now the last concept, in learning outcome A, we will be covering learning outcome A and B in this lecture. So I am on the last point, so please be attentive. Next 5 minutes are very important. Now I said spread, the difference, the widen the spread, more will be YTM, less will be the price. Now that spread is due to which reasons? What are the components of that spread? One is credit migration, that is downgrade risk, and second is market liquidity risk. So I will be discussing with a case study that what is the meaning of a credit migration and downgrade risk, and what is the meaning of liquidity risk. So for that I have taken the example of Apollo tires. Let the bonds issued by Apollo tires be of 12% and let the risk-free bonds be of 8%. Now the spread is of 4%. Now when I say spread is 4%, it means it is excess of this. Now why that excess rate is being offered by Apollo tire to their investors? It is due to multiple risks, and that risk I have divided, that spread risk I have divided into two parts. One is credit migration risk, downgradable risk, and second is market liquidity risk. So I have written that. So please write down. Then I will be explaining that when due to any event, supposedly in Apollo tires, due to internal problems or due to external problems, there was a bad news in the channel, in the news channel, and which has brought down the sentiments of the public, of the investors. It means it will increase the risk of Apollo tires. To invest in the bonds of Apollo tires, it will increase the risk. Now when it increases the risk, YTM will increase, and when YTM will increase, spread will increase, and when spread will increase, value of bond will come down. And similarly, a triple B rating can be converted to a junk bond, double B. We have discussed that. It means its credibility, its credit rating will be notched down to a lower version. Triple A to double A to single A, triple B to double B. So due to these reasons, this type of risk is named as credit risk or downgradable risk. And the second risk is people have stopped purchasing and selling the bonds of Apollo tires. There are no buyers and no sellers. When there are no buyers and no sellers, it means it is a liquidity risk. And when there is a liquidity risk, it means that YTM will increase, spread will widen, YTM will increase, price will come down. So please write down this point also. Due to less number of buyers or sellers, liquidity becomes less, risk of a bond, YTM will increase, price of a bond will decline. So due to less number of buyers or sellers, this will happen. So I think I have told you that what is the meaning of a credit risk. I have told you what is the meaning of a default risk. I have told you what is the meaning of a loss severity. I have told you what are the risks related with credit risk related with corporate bonds. So all that concepts I have told you with the help of case study. Hope you have enjoyed this lecture. Be happy, be jolly,